But despite the opportunity for a bargain, our next guest is warning investors to stay away from the trade, and he liked the home builders. For more, let's bring in Chris Grasanti at MAI Capital Management. Chris, it's great to see you again. Welcome.
Hey, thanks, Kelly. I'm here live from New York with the smoke behind me. So
it's wild. It's like an orange-red glow. Yeah. Go ahead.
Yeah, no, I was just going to say, great comparison. As you know, I liked the home builders a year ago, but also, as you know, these retailers really have rock bottom PE, so they are tempting. But I'd say there's a bunch of reasons now why you should be more careful with the retailers now than we were with the home builders back then. The biggest is, and this is kind of weird, but it's important, inflation is actually going down. And for most folks, that's a good thing. But for the retailers, it can be trouble. They're losing pricing power. Now, that's happening at the same time that volumes are actually starting to decline. They made up for that 6 months ago by increasing prices, but they're having trouble, again, because inflation's going down. And one of the biggest reasons is we think there's a recession coming. We're obviously a year closer to whenever that starts than we were last year when we were buying the home builder. So you add up those things, and it makes me wary enough, not to go in there, fools go in where angels fear to tread kind of.
So why was it, let's rewind the clock 12 months ago when we talked at length about, some of these home builders trading at 2.5, 3, 4 times earnings. Why was it, all right, two ways I'll ask this question. Number one, were you bearish back then, or were you more bullish? And kind of part two is, well, if you're bearish on the economy now, would you kind of exit that trade? So just kind of compare the macro with the setup for retailers.
Right. So home building is a really weird industry.
Yes.
So what you have is you had mortgage rates going up a year ago, so the home builders naturally plunged. But what ends up happening, and this is the weird part, is that folks like you and me who own their homes, all of a sudden we think, we're not going to sell right now because if we go buy a new house, our mortgage is going to be double. So those houses stay off the market. And the only homes coming onto the market are the home builders. So supply stays short, but the home builders have the only supply out there. And their business is actually surprisingly good. It's a really weird situation. Also, at the same time, lumber prices over the last year plunged. So those guys, the home builders, had enough money, both with decent sales and with lumber pricing plunging, that they can subsidize the entry mortgages for folks. So they can give it to them for under 5%. So that's a really unusual dynamic, and clearly the retailers don't have that. Now, having said all that, Kelly, I am getting nervous about the home builders trade. As you saw, they're up 40, 50, and sometimes 60% in a year. And look, I don't think the economy is going to be better next year than this year. I think it's going to be worse. So we are looking at that, and we have taken some money off the table there.
Then are there any retailers who you do like, and are there any super low valuation? At some point, if it gets to 2.5, some of these names, I think some of the department stores, couple of beaten down mall retailers, are approaching 2 or 3 times earnings, and you wonder, at some point there's got to be a margin of safety.
Right. And just like the home builders, we didn't go for the ones with the absolute lowest PE. Here, we want to go for retailers whose price has already fallen a lot, but they may not be like a 4 PE, and a 4 PE in a retailer to me is kind of screaming, is there going to be solvency issues, stuff like that. So that makes me worry. But Dollar General, which just got the crap beaten out of it last week, we think is really interesting here. This is a long-term story, but Dollar General actually does better in a recession as folks start to trade down. It's trading at one of its lowest valuations in 10 years. And even though it's trading at 14 times, not 4 times, that's about as cheap as it ever gets. So that's something we're looking at real closely.
I'm smiling because that does sound exactly like a strategic Chris Grasanti kind of move. All right, we'll leave it there. I don't know what was more informed, the stock picks or what's going on behind you.
I know, right? I better I might have to sleep in my office tonight.
Right, get that mask on. Chris, thanks so much. We really appreciate it today.
Thanks, Kelly.